Let me welcome on board Abhay Agarwal, who is the founder and fund manager of Piper Serica. And Abhay, very good afternoon and thank you so much for your time. First of all, let me have your take on the markets then, because finally some rebound on the benchmark indices amidst all of that global news flow, which is not panning out to be positive at this point in time. So what's your stance on the markets, as well as where are you finding opportunities right now?
Yeah, good afternoon, Srishti. Thank you for having me on the show. I think I've been saying this for a while now that this is clearly a buy on dips market. This is a market where there will be volatility and small technical corrections of 1, 2, 3, maybe 5%, but they will get bought into by investors who are looking to deploy the cash that they have been sitting on for a long period of time. And India, frankly, in overall geopolitical and all kinds of other issues, India is an oasis right now for both domestic investors who are continuing to deploy, and at the same time, international investors who don't want to miss the bus. And we have been seeing, we are quite encouraged by the kind of conversations we are having from with global allocators who are looking to India to invest for the first time in India. These are large family offices, pension funds, looking to increase their existing allocation. So I think that gives me the confidence to say that the flows from both domestic and international investors will continue to be strong. And very difficult to say if there is any one-off event that kind of reverses that flows. But knowing what we know, I think the flows will continue, and that means that any correction will get bought into, and that's the stance that investors should have. From our perspective, what we have done is we have recently rebalanced our model portfolio, booked some profits in small and mid caps that we had over allocated to last year at the same time, and redeploying them in large caps where we see more value now, because of the sideways time correction that some of very good companies have gone through. So I think that's the only change that we have made in the portfolio. Other than that, we don't have increased cash allocation or a higher cash allocation in the portfolio in anticipation of any sharp correction.
Not expecting any sharp correction in the markets right now, but Abhay, we also believe that you have actually hiked some of your allocations within the large cap space. So let me just quickly take you and touch upon a couple of counters that have garnered your interest. And first of all is Geo Financials, because even today we have seen great moves coming in. There's a buzz that Geo Platforms listing could be on the cards in the times ahead, and all of the telecom space is actually buzzing. But we believe that given the sharp up move, you have booked some profits in this one. So would you like to share your rationale? That do you believe that the valuations right now is somewhat the kind of potential that the company you foresee is somewhat priced in right now, and for any investor that has entered in the at a lower point, is this a good time to book out profits?
Yeah, especially so regularly rebalancing our portfolio is a key activity for us as fund managers. And talking specifically about Geo Financial Services, again, with a disclaimer, it's not a buy recommendation. We have the stock in our portfolio for a long period of time. So we had added it to the portfolio just when it had listed at about 200, 220, 220 levels on an average. And our model portfolio, our model valuation was showing a fair value of close to 300, even though you could say that the underlying businesses were not visible and still not visible. But we saw Geo Financial Services as a great financial services platform with a very strong book value of almost 1,25,000 crores. And we thought that the market is mispricing the company for the opportunity that it has in front of it. And I think the market is so big that it can actually absorb 10 Geo Financial Services companies. It's just such a large market and growing market. So that was our investment thesis. At the same time, what happens is that markets overreact to good and bad both. And we periodically book profits when a particular stock goes beyond their allocation in the portfolio, which is what we did. So we booked partial profit. At the same time, we are very, very constructive on Geo Financial as a very long-term play, over the next 5 years, 10 years. in the emerging financial services space of the country. Our thesis is that it's going to be a digital platform which will drive down costs for the customers, will be very competitive. It has a large customer base of almost 50 crores through its telecom and retail presence that will benefit from Geo Financial Services. So we see it as a very, very long-term disruptive and value creative financial services platform.
All right, still having that confidence in Geo Financials, and the time that Abhay booked down is an act of a rebalancing as per him. And Abhay, one of the other counters is Z Entertainment. We believe that it is one of your tactical ideas, and at this price point, what is getting your confidence back in Z Entertainment? Because we are seeing a lot of news flow around this, the kind of restructuring that the management is undertaking. So what's your take on Z Entertainment?
Yeah, so again, not a buy recommendation, Srishti, but in our portfolio, we typically have 20 to 24 stocks, and we allocate a very small percentage of 5 to 10% to some tactical ideas where we believe that market has overreacted to news, and the current market price is widely divergent from the core value of the core underlying assets. And when we did that exercise with Z, we found that even building in the issues around the management founders and the fallout of the Sony deal and some of the other issues, the core assets of the company continue to be very strong. They are all profitable businesses, leadership position in many of them. And what the company needed was a way to cut down its costs and stop the bleeding, increase the margins. And I think if that is done, the stock can re-rate significantly. So it is a tactical bet for us. We will see how it plays out. We will track the news very closely. We will track the quarterly earnings very closely, which will tell us which way the company is heading. But typically, we have seen that media companies benefit from a higher ad spend in election years. So it will not be a surprise to see higher media spend across the board. And Z would definitely benefit because of its presence in very large states, especially where the elections are going to be held. So it's a tactical call, as I said, with 5% allocation. And I think this is one of the things that continues to create alpha in our portfolio.
It's an allocation to the entertainment. And lastly, Abhay, before we let you go, wanted to touch base on the battery companies, because we see that Amara Raja is one of your bets, and there's been no stopping in this counter, especially after the Exide's announcement. Both the counters are excited, but you wish to go for Amara Raja. But why not Excite? Because amongst the race of getting their EV batteries first in the markets, we believe that it's going to be Excite. But what's building your confidence in Amara Raja? And do you believe that there's still opportunity left for investors to make any allocation to Amara Raja? Do you still find the valuations attractive?
Yeah, Suchi, I think this is a space we have been very bullish on, the battery space per se, both lead acid and EV batteries. And EV is basically a gravy on the top because in a large country like India, there is already a massive transition towards electric vehicles with full government support, what we have seen in two-wheelers EV adoption, we will see in four-wheelers, early stages of that, and then commercial also. So I think this is a very long-term play, and the way the industry is structured between two players, Amara Raja and Excite, they have the wherewithal to cater to that segment. At the same time, our thesis was also driven by the fact not only of the EV batteries, but also the fact that recycling of lead acid batteries has itself become a very big theme. And the government has clarified that all lead acid battery manufacturers have to use recycle lead 2 to 3 years from now on. So recycling is another initiative that both these companies have taken. The lead acid battery market continues to grow, and there is tremendous scope of renovation there also. So if you put these three things together, I think this battery space in India is going to be a very large space. These companies are still mid-cap stocks at best. And I think in terms of quality, very similar quality of management, business orientation, innovation, commitment to excellence. We chose Amara for the simple reason that the valuation is much more attractive than Excite. And that was our only call. But I think both these companies are very, very good companies. This is a macro trend that will play out over next 5 years, 10 years. So investors should stay on the right side of it and not look at trading these stocks based on near-term performance.
Well, thank you so much, Abhay, for sharing your perspective on the battery companies as well. With this, we'll let you go on that. Thank you so much for joining us today, sharing your outlook on the markets and discussing some of your stock ideas as well.
If you like this video, then like, share and subscribe to ET Now.